All right, I know you came here for some good old-fashioned fun. I don't want to keep you waiting. Let's jump into our first question on inventory. So assuming constant inventory quantities, which of the following inventory costing methods will produce a lower inventory turnover ratio in an inflationary economy? First approach here, we read this question, and if any question mentions a ratio or a formula, I want you to immediately write out that ratio or formula. That way you know what it's asking, because within that ratio, it's likely going to have a component, whether the numerator or denominator, and that is going to be what it's asking about. So here, I'm going to give you a second to think about it. What is the inventory turnover ratio? All right, so that is going to be cost of goods sold divided by the average of the beginning and ending inventory. Okay, so we have our ratio. Now, you might recognize these questions. They are pretty frequent, and we have a period of rising prices, a period of declining prices. What's the value of ending inventory, of cost of goods sold? It loves to ask that over and over. So here, inflationary economy means prices are rising, right? So what happens? So our values of everything are going to go up if prices are increasing. So which will produce a lower turnover ratio? Ratios get lowered by the numerator increasing or decreasing and the denominator increasing or decreasing. Now think about what would make that ratio overall decrease. Well, I would say it is going to be an increase in the denominator or a decrease in the numerator, because, and you can play around with it numerically, right? So if I have a ratio, if I have 3 to 4, well, how do I make this smaller? I either increase the denominator, that's a smaller number, or I could decrease the numerator, and that's a smaller number. So here's our original one. So you see there, so we basically want to either, in this question, decrease COGS or increase inventory. Okay, so would FIFO, LIFO, moving average, weighted average? For these questions, I'm just going to straight up tell you, we're going to eliminate the average ones, because that doesn't take into account a period of rising or declining prices. It averages everything out. So that is going to, 9 times out of 10, I can't really imagine a question where it would be an answer. So we're going to get rid of that. Now what I have here for you is a chart that shows you what happens in LIFO and FIFO. So this is normal. We buy good 1, we buy good 2, we buy good 3. FIFO, 1, 2, 3. LIFO is switched out, right? We use the last in, which is the most recent, 3, 2, 1. All right, so here, which of these is going to be producing a lower inventory turnover ratio? I'll give you a second to think about it. So under FIFO, the inventory is the most recently purchased items, and LIFO is the opposite. So if prices are increasing and FIFO has the most recently purchased items being used, then FIFO is going to have a lower cost of goods sold. So FIFO is going to be using the, pardon me, did I say most recent? FIFO is going to be using the oldest. And you got to think this through. You see it right here. You got to think it through. So this is going to be using the oldest. Prices are going up. So let's say this costs 5, this costs 10, and this costs 15. Prices are going up. So here, we are going to use that order, 5, 10, 15. Okay. And if prices are increasing like they are, it would be the opposite for LIFO. So prices would actually have a lower inventory value under LIFO because we'd be using those ones. So let's see. In this one, final answer is going to be FIFO, first in, first out. That is going to produce a lower inventory turnover because it is going to result in, as we saw here, a lower cost of goods sold and an increased value of our ending inventory. Awesome. Moving on. we have a more math-based question here, taking into account a couple other factors. So what amount of inventory should Stitch report in its year-end balance sheet? In January, Stitch Inc. adopted the dollar value LIFO method of inventory valuation. Now, if you haven't seen dollar value LIFO, this is a separate, different type of LIFO FIFO weighted average, and that's why I picked it out for you here today. We're going to go through it. So, of inventory valuation. At adoption, inventory was valued at $50,000. During the year, inventory increased $30,000 using base year prices, and prices increased 10%. The designated market value of Stitch's inventory exceeded its cost at year end. All right. So let's do some math here. Well, how dollar value LIFO works is we're trying to take into account the price increase. So we're going to use a base year cost, which generally is going to be our beginning cost. So in this case, base year is going to equal, what are your thoughts? Well, at adoption, at the beginning, it was $50,000. Okay. During the year, inventory increased $30,000 using base year prices. Okay, so we're going to include that amount as well. So our total base value, base year cost, is going to be $80,000. Next, we need to use our current year cost. And our current year cost says prices increased 10%. So from here, our current equals 80,000, because we're going to take our base and multiply it by 1.1. That is 10%. That's how you account for a 10% increase in something. Like if I said I had a 10% return on my $80,000 investment, this would be the same process. And that is going to get us a total of $88,000. So that's our current cost compared to our base cost. Awesome. Now, we're trying to figure out what we need for our year-end balance sheet. Okay, so we want to layer. This is the process of dollar value LIFO layering. So we're going to use our 88,000 and compare it to our base year cost. Now, this step, I mean, obviously is just repeating how we got our 10% amount. So that's just the 1.1. That's just kind of to show you as well how the process moves along, because you might have to do this for multiple periods as well. So we are going to add a LIFO layer added to our increased amount of 30 times 1.1. That's going to get us to $33,000. And our ending inventory, which is what we're trying to find, is going to be our base cost original amount of $50,000 plus $33,000. And that's going to get us to a total of $83,000. Now, two thoughts on this. You may be a little confused if you haven't seen this. Hopefully you have seen this by now. One thought is this is just the process, right? Like there's a lot of explaining to be done for why a lot of the things in this test are the way they are, and a lot of them just aren't worth the time understanding. I mean, this one I could definitely, I'm sure you saw it in the lectures and you understand it a little bit better, but personally I would recommend just kind of memorizing the process for dollar value LIFO. Secondly, like this is trying to take into account the time value of money, the increase in prices, possible decrease in prices. That is kind of what's happening, and it ties into the first question we saw, except more practical. It's seeing more, okay, what actually happens with our price increases. In this case, it was a period of rising prices of 10%, and this is our ending inventory amount. So it's quite similar to the first one. So 83,000, final answer. Hope you all enjoyed. I know this was what you were looking forward to all day, is seeing some inventory questions, and I hope it satisfied your need for them. All right, guys. You guys have a great day, and I will see you next time.